Head of Research at the Murray Wealth Group. It's great to have you here.
Thanks for having me on.
And it's great because you're going to talk us through a bunch of stocks. You're taking a bunch of companies that are reporting today. Start off with Manulife. Are you an owner of those shares?
Yeah, so Manulife, we are an owner. We own this in our income growth fund, and we actually have just very recently exited owning Manulife in our global equity growth fund, following the 80% rise in the shares over the last year. What can you say? It's been a great story the last 12 months. The new management team that's been in place for about 5 years now has done a great job turning this around. They've exited the low return on equity businesses. They're firing all cylinders. I think this is like their fifth or sixth profit beat in a row. So numbers have just gone higher and higher. We have seen the valuation go from 7 times PE up to 11. So not a stretch by any means, but it's more in the range of the rest of its peers and not as significantly undervalued as it was last year. But the company's executing, the dividends are flowing, they're buying back stocks, so everything is looking good at Manulife.
For years, they underperformed Sun Life Financial. I think it was partly an overhang of less profitable businesses.
Yeah, less profitable businesses. They put a ton of capital into some of their underperforming businesses following the financial crisis. And I mean, a financial company is all about balancing capital and return on equity. You can run with lower capital levels and have a higher ROE. You can have a fortress balance sheet, as they called it back in the day, but that's going to bring your returns down. So it's all about finding a good balance where you have stable businesses that generate those cash flows and you can lever up to the right level. And Manulife's found the right balance.
BCE, the parent company of this network, under fresh pressure today, warning that sales will drop this year.
Right, so BCE, and I mean the whole media or telecom space in Canada has been under pressure all year, and it's really the same thing. I mean, there's a lot of concern around BCE on the dividend. The acquisition they announced, I think, on Monday was not very well received. Investors really wanted that money to go towards debt repayment. But this all really comes back to the wireless sector in Canada, we think, where we're just seeing price wars. There's heightened competition with the regulatory changes that brought in wholesalers into the market. And so it's just a really, really tough market environment. And so until that changes, it's going to be hard to see BCE and other telecom companies, we think, show a sustained rally. Now, that could change, I mean, at any moment in time. There's also Quebecor who's in there and is really kind of stirring the pot in the wireless segment. But we could see them at some point when they've achieved enough scale, start to pull back on some of the pricing levers they've been using to help out their own profits. So it's a tough market for these companies, and it'll be tough until that changes.
Do you applaud BCE diversifying like that into the States?
We were not a big fan of the deal, partially because we think, as much as the management team was talking about how it's an offensive move, we viewed it as, is this purely just offensive, or is this a cover to adjust your payout structure that they did? They introduced the DRIP, which is really the big change we thought. It's not, we do own a small amount of BCE in our income growth fund, and we're not fussed about the dividend pause. But by introducing that DRIP, so the dividend reinvestment plan, they're now effectively issuing shares at today's price, $38 or whatever the price may be on the next dividend payment, to pay that dividend. And so that's going to be dilutive to shareholders going forward. And that's, for us, was the big problem with that acquisition.
And there's a slight discount for stockholders if they buy into those shares.
There is, but those who prefer the cash are then getting more and more diluted. Your ownership gets a little bit smaller every time.
Right. In theory, now the yield on BCE going to almost 10.5% today.
Yeah, and I think that reflects that DRIP discount. And as well, investors don't see BCE as in the all clear yet. So they're still talking about a 2027, 2028 timeframe to see free cash flow per share improve. And I mean, that's still a long ways away. So there's still a lot of uncertainty, unfortunately.
So-called normalized earnings per share at Canadian Tire came in ahead of expectations. Revenue was down year over year, but it was slightly ahead of the estimate. Is this a stock you own, Canadian Tire?
It's not a stock that we own, but it's a stock that is executing well given the circumstances. So Canada's a bit of a slow market right now. There's price pressure in the housing market, obviously, that affordability concerns. Still dealing with the hangover from inflation and higher interest rates. So retail spending in Canada is down. Canadian Tire is managing this well, so their margins are what they can control. They can't necessarily control the sales, especially as a large general merchandiser. So they're doing what they need to do, and we think when the retail sector in Canada does turn, Canadian Tire will probably have a new leg higher. But for right now, we think it'll tread water while Canadian consumers are pressured.
And just finally, Lightspeed, is that a stock you own? Still way down from its peak.
Yeah, it is way down. We've owned it in the past. We haven't owned it for 2 or 3 years. What Lightspeed is doing, and we're getting a little more constructive on it, is they are improving the margin. So they've always had revenue growth, but there hasn't been that profitability, and that's where the focus has shifted to in the last few years. They're still growing the revenue, but we want to see that free cash flow and EBITDA number move up. So they had better numbers on that. But the big news, I think, on Lightspeed was they had an investor day scheduled for later this month, and they've actually postponed that. And so the market's taking that as a sign of this is a company that's talked about strategic reviews and potentially a corporate sale. And if you're postponing an investor day, is that a signal that maybe there's something coming sooner than later?
We've got to take a break. We're going to get Jamie's